Friday's surprisingly strong US jobs data fueled the Fed hawks before this week's FOMC decision. So the US dollar gained and the euro declined, also hammered by the not so European-friendly election results on the continent level last weekend. Now all eyes are on the latest US inflation data, the Fed and the Bank of Japan's latest monetary policy decisions, and Apple's developer event, which should maybe shed light on the company's plans to integrate AI into its offerings. So welcome to the new week of trading with Swissquote's Daily Market Talk. Okay, so forget everything we said last Friday when the US jobs data was expected to come in at least reasonably soft to confirm the softening trend in the jobs data that we observed through the rest of the economic data that flew in throughout last week. Because the sight of the 272,000 new non-farm job additions in the US and the fastening wages growth above the 4% level on a yearly basis actually smashed the dovish Fed expectations last Friday and sent the US 2-year yield, which captures the Fed bets, from around 4.70% to 4.90% in a single move. The 10-year yield spiked to 4.45%, and the US dollar index cleared the 100 and 200-day moving averages without any hesitation and jumped over the 50-day moving average this morning in Asia. So we are basically back to the starting point, to the reasoning that the Fed could hardly justify a rate cut when jobs data remains this strong in the US and inflation is not necessarily easing as fast as it should. Now, happily, suspense about what the Fed thinks about all this won't last long, and we won't have to go through a million Fed speaks and speeches to come to a general conclusion regarding what will be the Federal Reserve's next step. The Fed instead will start its 2-day monetary policy meeting as soon as tomorrow and will be announcing its latest monetary policy decision on Wednesday, just after the CPI update for May. That's due the same day, a little bit earlier. So Wednesday will be the important day of this week of trading. Now, data-wise, price pressures in the US may actually have steadied and even slightly eased for the core inflation measure in May. But the numbers are still hanging around the 3.4 to 3.5% levels, which are well above the Fed's 2% policy target. And the last mile, so easing from these levels to lower levels, so towards 2%, proves to be harder than many thought. Therefore, the Fed and its chief Jerome Powell will probably ask investors for more patience, and their quarterly dot plot will more likely than not show lower interest rate cuts or lesser interest rate cuts this year than they predicted back in March. I believe that the median forecast on the Fed's dot plot will show 1 or maximum 2 interest rate cuts penciled in by the Fed members this year, and that would be down from 3 rate cuts that they were still flashing back in the March meeting. And let me tell you one thing. 2 interest rate cuts in the US would hint that the Fed officials are quite worried about a hard landing for the US economy and even a recession. So to me, the best outcome for the market mood this week would be a single rate cut projection. Now, for now, the equity market's reaction to Friday's strong US jobs data was quite contained. The S&P 500 and Nasdaq closed last Friday slightly in the negative, but after having advanced to fresh record levels. The GameStop frenzy also probably came to an end last Friday, when fun couldn't overweigh fundamentals anymore, because while Roaring Kitty was yet on another mission to pump the market price of GameStop on live stream show, while GameStop actually decided to reveal its latest quarterly results earlier, surprise, and the results were unsurprisingly bad because GameStop is a non-profitable company, we know that. But, the results also happened to be worse than expected because the company revealed a 29% drop in its revenue and a quarterly loss of 12 cents of a dollar per share. So, the GME shares finished today 40% lower, guys, and I guess that this is pretty much the end of this wave. Now, more seriously, if the major US indices could eke out weekly gains last week, it was mostly thanks to, well, a decent rally that we saw across chip stocks that, well, actually saw the Computex event in Taipei, remember, give them a decent platform to show off their new chips and also talk about their future plans about AI. So this week, the technology investors' focus will be on Apple's annual WWDC event, where it is finally expected to reveal a roadmap regarding its own AI ambitions. Now remember, Apple fell off the early AI race as it hasn't come up with a solid AI plan so far, while its technology competitors like Microsoft, for example, and Google, well, they both have been racing relentlessly to get out the most efficient and the most impressive AI models to gain field. Now, interestingly, Apple's stock price recovered quite well as AI-related losses on hope that a partnership will eventually pop and make Apple's iPhones and iPads and its computers, well, appealing again. And as we had discussed earlier this year, remember, many investors don't actually see Apple as a cutting-edge technology company, but they see it rather as a luxury brand that sells millions of hardware that could be home to an AI model. Any reasonably appreciated AI model would be fine. Therefore, investors are not necessarily bothered by the fact that Apple isn't leading the AI competition these days, but every investor actually agrees that Apple, well, should develop their AI offering fast and very fast, and this week's WWDC event is that line in the sand, and the expectations are high. So either Apple will come up with a satisfactory plan regarding its AI offering and deserve to see its share price pushed to a record level, or the week will end in tears with disappointment and Apple will give back the AI hope-related gains. What is sure is that, well, the entire world is watching. Now, elsewhere, the post-US jobs data rally that we saw in the US dollar across the board pushed the dollar-yen above the 157 level and the euro-dollar off a cliff. The yen traders will lack conviction these days that the Friday's Bank of Japan meeting could bring any hawkish shift in the BOJ policy after the latest growth numbers showed a contraction in the first quarter growth numbers. Now, some believe that the Bank of Japan could make some minor adjustments to its JGB purchases to keep the Japanese yen weakness contained, but I don't think that we will see anything major. Here in Europe, well, the euro-dollar got smashed from around 109 level to 108 after Friday's surprisingly strong US jobs data and got a further hit this morning, well, after the weekend's European Parliament elections ended in tears for, well, France's Emmanuel Macron and Germany's Olaf Scholz parties. So the far-right Marine Le Pen, for example, secured 32% of the votes from the French, a shocker, but a real shocker that pushed Macron to call a snap election in France to get things straight. As such, well, the French 10-year yield kicks off the week with a 2% advance, and well, the advance is quite similar elsewhere in the Eurozone yields as well. The euro-dollar returns to the bearish consolidation zone after taking out the major 38.2% Fibonacci support on the April to June rally. So the outlook turns negative very quickly, and I believe that the impact of the political shenanigans in Europe will remain quite short-lived, but a hawkish Federal Reserve outcome this week, this Wednesday, could prove to be quite harder to shake off. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.